All right, hey guys, I'm Will Roberts. I'm a Naval Academy class of 2014. The last real plebe summer. It's 2 years behind you?
Yeah, it was 2012.
Yeah, she's like she's
I
one of
mean,
my detailers.
Mine was the last real plebe summer, let's be real.
Yeah, well that's because you were my detailer, so yeah, to set you up for that. Yeah, it went really easy on us. That's my face. I just want to tell you that if there's any first years here, you're already making better decisions than me, because this is my view out of my hotel room this morning. This is like it's not a flex, this is like $140 hotel room. But this is my view outside the hotel room. This was my apartment window in Philadelphia. So you're already making better choices than I was. And that's the whole point of today. I hope that that you can learn a lot about the VA loan and learn that you can make better, just cycle to this, better decisions than I did as a first year, thinking that I had to go to New York or Boston or some big city and live in a big city apartment and do that stuff. So I'm originally from New Orleans. I went to the Naval Academy Prep School, the Naval Academy, still the Marine Corps for just under 6 years. Did a tech startup called Paintrue with a bunch of other Naval Academy grads, which was cool. Learned that I knew nothing about the business world, which is what led me to Wharton. And then afterward, I worked as an investment banker in New York City at Allen & Company, which was a cool spot. Tiny little bank, does big deals. We did Adobe Figma while I was there, Activision, historical stuff is like Google, IPO. It was a great spot. Left there in July this summer, started my own private equity fund. It's real estate centric, called Roberts & Company. And then about 2 years ago, I started with some buddies to build the Veterans Alliance, which it's 11 vets, 10 of us are service academy grads, and to a person, we all got screwed over using the VA loan. And we were like, there's gotta be a better way than our friends, brothers, sisters, patriots, whatever, getting screwed over using the VA loan. Because we found out that there's a lot of experts, right? And when we look up on our broker side of what an expert is, it's like, oh cool dude, you did 5 VA loans last year. We did 50 last month. So it's like, we have become the #1 VA loan team in the country, which is cool. And so I would consider myself a subject matter expert. I would consider us subject matter experts. Because this is really all we do. We write conventional loans and FHA and USDA and all that stuff. But what our bread and butter is helping people that we connect with on a personal basis. So this should really say, what is a broker and what is a retail lender? So your retail lenders are like Loan Depot, Chase, Veterans United, Quicken, Wells Fargo, stuff like that. So they're lending off their internal balance sheet, internal rates, internal products. Now some of that stuff's really good, right? I'm not gonna discount the fact that Navy Federal has a 0 down loan, but if you're ineligible for the VA loan, and we can talk about that later, Navy Federal is your go-to. And I'll push you towards those if I recognize that we don't have a product that can help you. But what we do is we work with 45 wholesale investors. Those people give us price updates throughout the day. So I'm constantly getting text messages and emails saying hey, we have a $2 million block of loan at 6%. Do you have something that can fill that? And we're like, hell yeah, we do. We got a $750,000 loan with a dude, 800 credit score. Can you give it to us at 575? And they're like, yeah, we can. So it's pretty cool. What that gives us is instant pricing authority. Because we bid against people, we bid these companies against each other. We can do what's called a voiceover. So if I was lending off my internal balance sheet, candidly, this conversation can never happen because I can't give you a leg up when I'm writing my own money. But since I'm not an underwriter, I'm not lending off my balance sheet, I have no financial tie to you, I can help you. I can coach you through stuff if it's your credit profile or sticky situations, high debt to income, weird stuff I want to buy mixed commercial use, how do I do that? We can kind of game this through, and I want you to win. I want you to get the best rate possible. I don't receive any compensation off your rate, your loan size, none of that. It doesn't matter to me. You buy a $500,000 house, cool. You buy a $5 million house, cool. Doesn't really matter. We're bigger loan guys, they might not want you to get a great rate. So truths about VA loans. So I constantly get asked hey, the VA is lending me money. It's no. The VA is guaranteeing 25% down. So the VA says let's just take $1 million loan. on $1 million loan, they're gonna give the bank, if you foreclose, $250,000, which is the same thing that you're gonna do if you're a civilian buyer with your down payment. So normal down payment's 20-30%, the VA is just guaranteeing that. And so for the loan, or for the lender, they're gonna be like, oh yeah, I'll take 100% loan to value at X%. So that's why you immediately see a little discount from your normal rate. You probably see about a 40 basis point, 0.4% discount, because they're loaning more money for the same asset. So it's pretty good for them. You can use your VA loan more than once. Like technically you can buy as many VA houses as you want. And that's the only limit. That's where your county loan limit comes in. So in California, like in this county, it's probably like 1.14, I think. And so you could have 10 $114,000 houses, or you could have one $4 million house. So you can do one house that's over the loan limit, or multiple that meet the loan limit. We can talk about that later. You can buy a condo. That's a new thing that just changed. Years ago, the VA was like really rigid. Like you have to buy a single family house, no condos, because condos sometimes get ownership over the properties and some interesting stuff. That's changed in 2021, because like anecdotally, the VA has 3 missions. It's to provide medical care for vets, training, education, get jobs, and secure housing. And they were like utterly failing in 2020 and 2021, because vets were losing out on houses to an all-cash market. So they changed all this. So that means that you can buy a fixer-upper. Like I bought a fixer-upper, questionable decision sometimes, but chipping paint, you know, new kitchens, all that stuff. We can do what's called a rehab loan or a renovation loan, and you can buy a $750,000 house, put $250 into it, and then you know, have a loan at $1 million where you got $250,000 in renovation credit, which is sweet. This is a huge one. This down payment or earnest money. I can't tell you how many times I hear from sellers agents specifically, your buyer doesn't have any skin in the game. And I'm like, well, you didn't have any skin in the game when he was in Iraq. So I don't want to hear that like he doesn't have skin in the game. What they're meaning, or what they're saying, is that compared to someone that puts 30% down, you doing a 0% down loan, you don't seem like you're as interested. That's ridiculous. Number one, it's ridiculous, but number two, you can put as much money as you want down and we'll credit you on the backside. We'll credit you at closing, so it really doesn't matter. The other thing is like, and this is where working with someone that actually knows what they're doing comes in, because I can tell we can structure your offer letter to make it seem like you're doing, you know, a big down payment, and in reality, you're not. And that doesn't really matter to the seller's side because the cash is green on closing anyway. So items can be waived. This is a huge one. So back in the day, like you had to have this mandatory inspection with the VA loan, and you had to have an appraisal. That's still a valid thing, but like there were all these like secondary inspections and stuff. Basically, the only thing that's mandatory now with the VA loan is an appraisal, which is nationwide. Any funded loan, any loan on any house has to have an appraisal. That's like 2008 doesn't happen again, right? So like the other only mandatory item is a termite inspection in some states. Again, that's federally mandated. So I'm just gonna check to make sure the cameras are on for these, for anyone else. So basically the VA loan is this like incredibly dynamic thing now. No size limit. Now, if you can qualify for a $5 million house, I could probably find a lender, or a wholesaler rather, that will lend you $5 million. And that comes into play in multifamily situations. We've written up to $4.5 million single and multi. So it's not that it's like, it's not a question of if, it's just when. Like when are we gonna have that buyer that wants to buy a $6 million multi that qualifies for it, and the DTI makes sense, and it's got 4 units or 3 units that have income requirements and all that. Like, it's pretty cool. And it's the only home loan that's earned. So don't ever let anyone take that from you. Like, that's the thing. It's like, these people will tell you like, oh, you should use, you know, a conventional loan because it makes you, no. You earned it, use it. Like, if it makes sense, use it. And that's like, that's where having someone like me or another broker come in and saying like, I think this is the best package for you, makes sense. So your eligibility, if you're active duty, you qualify. If you're active duty for more than 30 days, qualify. If you're a National Guard and you're active for more than 30 consecutive days, qualify. The first thing that we're gonna do when you call me, or text me, or email me, whatever, is we're gonna pull your certificate of eligibility. And this is what that looks like. So on this, it's gonna show, this is when I did Chesty Puller's loan in DC. So Chesty bought a $4 million house. So what all this does is show you if you've got a loan. So this is a big thing. If you find, maybe you had a loan when you were stationed in Fort Bragg, and then you sold that house, but it's showing up on the COE, we need to know like day one that there's a mistake. Because any mistakes take about 20 days. It's like 20 days to get to the VA and like 20 days to get back. So it's like 40 days. So like day one, we gotta know if that's wrong. The other thing it's gonna do is show us our entitlement. And this is a big one. This basic entitlement is 0. You will see a lot of lenders that don't know what they're doing saying like, oh, you're ineligible because you have 0 basic entitlement. It's not true. Basic entitlement to a veteran is $36,000. That's based on a $144,000 loan. And that means that every single vet nationwide gets 36 grand. So just don't let anyone get you wrapped up around that. That's not what that means. What we do is we take your basic entitlement, and then find out what the current entitlement is for that county if you want to buy another house. If you've never bought a house, this doesn't apply to you. So funding fees. So funding fees for this are pretty low. It's around 2% usually. 2.15 for a new buyer. If you have any VA disability, you're talking 10%. You got tinnitus or like your toe hurts, you don't have funding fee, which is great. So, and then if you're active duty, it can be waived if you have a Purple Heart. The other thing is that it can be waived in arrears. So if you bought a house on active duty and then you were later the recipient of a Purple Heart, which I had a gunny that happened to, his funding fee was then reversed, which was great for him. Another example is we had a Navy vet buy a house, and like a year later, she had a service-connected disability, which predated the purchase of her home. She had her VA funding fee reversed, which is cool, because the VA sends you a check for $30,000 or so.
So I've used the VA loan once, and I'm about to get my disability rating here in a month or two. How do I go about getting that refund?
It's automatic.
Oh, cool.
When did you buy your VA loan?
Early 2021.
Were you on active duty?
Yes.
Unfortunately, no. So it's only post active duty unless you had the Purple Heart. Purple Heart's the only case that I've ever seen an active duty service member, or rather a home purchase while active duty, get the funding fee reversed.
So does the funding fee get roped into the entire loan?
Yeah. So that's a great question. There's 2 options. So we can either roll into a loan, which you would just pay the same interest rate basically on your loan. That's called a VA no cost to close, no down payment, or you pay it out of pocket. It just depends. So it depends on the size of the loan, your debt to income. Like this is just a talk that we have and figure out what you want to do.
Okay.
I would say that most people just choose to pay it, and then they just pay their loan amount after that. But it's totally up to you. But yeah, I mean that's that.
And once again, any service-connected disability, 10% waives that.
10% or more. Yep.
Please.
Yeah, anything.
Go.
I have a quick question on the, I guess the county loan limits. So
Yeah.
I was on active duty, took out a VA loan to buy a condo in Tacoma. So now let's say I want to buy another one.
Yeah.
Would I have to, is that governed by the limit in Tacoma, or is that governed by the new one?
I'm going to show you how to calculate that.
Okay.
Please, that's a great question, and one that I definitely want to run through. It's very simple, but it's one that gets people really shaken up because they don't quite understand the difference between like county limits and all this stuff.
Okay.
So at the end, I'm actually going to show you a case study on how to do that.
Okay, so thank you.
Yeah. Qualifying. So there's 4 things. There's credit, assets, income, employment, property values, and appraisal. The first one you can't really control, but you can control. Second one you've built. Third one is what you're here to do. And your fourth one is totally out of your control. Just let it happen, and hopefully it works out. So the first one, credit scores. I'm not going to bore you with like what a credit score is. Don't just go off what like Discover or like American Express is telling you, we see those vary like 100 points off your credit score. You get 3 free a year through annualcreditreport.com. Do that. Or if you have already used them or you don't want to do it or whatever, because we're a broker and again not lending off our balance sheet, I can do a soft pull for you. And it's like I pull all 3 of them. It's really easy. And then at that point, we know exactly what your credit score is. Most of you are gonna have fairly solid credit scores. You really just need like 720 and above to get the best loan possible. Anything above that is great. Like 740, 780, you're getting the best loan that we can possibly find. So because I'm a broker and not a direct lender, I can do a soft pull if I was, and we do a hard pull like right before we close. But if I was a lender, I'd be pulling your credit hard, which is like a hit to your credit score, not cool. You know, you don't necessarily, you want to avoid that, especially in this like 6 months to a year time frame before you buy a house.
Is it a hard pull if we use that?
No, that's this is just looking at your report, and if I pull your credit, like a hard pull is like me as a lender saying like I want to know what this person's score is to get loan X. And like there has to be it's like pulling like if a police officer's gonna pull a license plate.
Gotcha.
Like there has to be a reason that they're gonna do it, so that's why it goes on your credit.
So even if you're above that like threshold that you mentioned, mid 700s, you recommend not to have any more pulls within the previous 6 months, year?
Okay, so I applied for a Lowe's credit card just because I had like an 800 credit score.
Right.
It's gonna hit you like 5 points.
Right.
Just don't like, if you start working on your, if you wanna buy a house in June or something, like, don't rack up a bunch of credit card debt or go buy a new car like 15 days before we close, cause it's just gonna like, there are ways that make sense, right? And like we can work through that, like you know it's coming, but don't just like have me be surprised one day like, oh yeah, I bought a $60,000 Tahoe the day before, which we've had happen.
Yeah,
Just like,
I've missed all the payments for the last 5 months.
yeah. Like, this is cool, right? You can work around this. I'm like, yeah, sure. Yeah, it doesn't like, it's case by case basis, right? If you've got the score flexibility, you're fine. And yeah, and again, like if you do need, like don't be scared. Like if you do need a car or like you have student loans, or like all that stuff's fine. Because the biggest thing is your assets and your income. So your assets, anything, 401k, IRA, stocks, TSP. This is a big one. Gifts from any non-interested party. So your parents, your spouse's parents, your girlfriend, if they give you money, right, and then they just don't have any ownership, which means that it's not directly tied to the property that you're buying or property that you own or anything like that, it's just a gift or a loan at 0% even, that's cool. We would just need a gift letter and the party involved. So that's it. If it's your parents and they lend you 50 grand at 0.001%, all gravy. That just goes into your DTI. This is a big one. If you do get that gift, just make sure it's been sitting in your account for 60 or 90 days before we close. Because that's called seasoning. You don't just want to see some like $120,000 deposit the day that you go to close, and that's what you're using for your funding fee. Like that's a little weird.
Is there an amount that requires that, like counts as a gift? Is it like 10,000
Yeah,
or more or something?
it's this year it's $18,000.
Yeah.
Oh, it's 18.
Yeah, but as long as you are paying, like as long as it is a loan, it can be technically like get advice from a CPA. But like my understanding is that as long as it is a loan, you're paying some amount of interest to the person lending you.
Yeah, you
to
don't have to pay taxes on the
Correct.
trade, yeah.
Yeah. So just if that comes into effect, just very simple loan contract, paying 1% per annum to, mama, whatever, all good. And then we just factor that into your DTI, which is cool. Income and
I wish my employer would do that.
Yeah.
Here's a 0.0001.
I mean, you find that employer, you let me know. So this is the big one.
From
So
the days.
normally you need 2 years of work history, but we've been able to do it, and this is actually how I kind of got into this, because when I graduated Wharton, I couldn't find anyone who would listen to me. Like I wanted to buy a house. I was going to New York. I wanted to buy a house. And they're like, okay, we can't use your income. My wife is active duty. We can use your wife's. You qualify for the county loan limit of 1.125. And I was like, that's a lot of money. That's not a lot of money in New York. Like, I was a rower. I am not short. I was the shortest guy on the team. Like, I'm not short, but I was short in that sense, right? So like, that's a lot of money. Not a lot of money in New York. So I was like, I can't buy a house that I need, like a condo that I need. And they were like, oh yeah, you can't buy condos. And I'm like, oh, this is wrong. So that's why I went on this mission to find out all this stuff myself. So come to find out, you can get an offer, as long as you have a full-time offer letter that starts 60 days before you close on your house, or sorry, 60 days after you close on your house, you can use that. So like, you're going to Google and you're gonna make 135, 150, sweet, like we'll use that. Your disability gets plussed up, or any non-taxable asset, or sorry, non-taxable income, so BAS, BAH, gets grossed up 25%. So if you make $4,000 a month in non-taxable income, it's actually $5,000 a month when it comes to your gross. All that stuff is great. For those that have pre-existing rental properties, if it is not your primary residence moving to a primary residence, meaning that you currently live at it, or if we can like make it look like you live at it, and you're moving, you need to have 2 years of rental history and 3 months, and that's rental history on your taxes. That's a big thing. So like, we can't help you necessarily for like 2023 or 2022, 2021, but like 2023, if you're thinking about buying a house, like this is where having a conversation with me and being like, hey, like I usually say we don't make any money. I'm gonna be like, maybe show me you make $1 or something, like, and that's where it comes in.
So my wife and I are looking to use the VA loan, but
Yeah.
because I'm first year, I'll be doing an internship and won't have a full-time offer. But my wife does have a job.
Perfect.
Would we still be eligible for
You
this?
can't use your internship offer, unfortunately, unless you want to close 60 days after starting a full-time, or sorry, 60 days prior to starting a full-time job. But we could definitely use your wife's.
Okay.
If you have disability, we can use that. In certain cases, I assume you're an MBA, so you're only in school 8 months a year. But if you were in a like year-round program, like medical school, then you could use your some benefits. But most likely, without like seeing your specific stuff in front of me, it's most likely to be your wife's income and then your VA disability if you have any.
Okay.
Which is like honestly like, you know, I don't know what your wife makes, but like, but you can qualify for a pretty great house on that, usually. So.
For the rental property, does that have any implication on using, like the banks or whatnot, seeing it as collateral? Like, or is it just the income for the specific property that could be used to boost up?
You mean if you wanted to use your, like.
Cause it's
that-
still an asset, right?
Yeah.
Like your equity in that house,
Yeah, so, you,
to be honest,
You
I just
could not-
haven't reported much rental income over the past 2 years. It might change now, that makes sense.
yeah, I mean, let's look first.
Yeah.
It depends, but most likely they're gonna make you say no, but it like, in the manual underwriting phase, it'll help you, cause it'll de-risk your portfolio, or your application.
Yeah.
You could do like a home equity line of credit or a cashback refi and then receive that cash that you have in equity, but it's gonna be tough to find someone that's gonna be willing to be what's called a second lien holder. To be a second lien holder on one property and then a first on another, like, I've never really seen it.
With no tax rental history income on that property. Cause to them, it's sitting vacant.
Yeah.
Okay.
Well, I mean, realize that you get 27.5 years of depreciation on the assets. You bought a $275,000 rental property, you depreciated $10,000 a year, right? So if your rental income is not more than $10,000 a year, you're technically not making any money.
Mm-hmm.
But like, I'll show you, I own a rental property. Technically, I don't make any money. I make a lot of money on the rental property. So there's ways to like, and that doesn't necessarily matter in this stage. It's just like, it matters if you had like, you know, we helped someone the other day that had 4 rental properties that were trying to buy their 5th. 4 of them were with the VA loan, just trying to buy an FHA loan. You actually end up doing math because they're like, wait a second, like all of these are within the same radius. Like this is odd. Yeah, that was funny. Yeah, he like, so
That's
you
pushing it.
can move within a year. So if you're over a year, you can move. No worries. If you're within a year, there has to be like a reason. I'll talk about the reasons, but you know, you can be like, I don't feel safe where I'm living, and then you move down the block, probably not the best move. Like, that's what this guy did. He literally like bought one in Virginia Beach, moved like a mile away, bought it. He's like, I don't feel safe. Moved again like a mile away. Like, that's probably not good, dude. Like, probably want to. And so what's great is he also used the same. I'm not gonna say which bank, but he used the same bank on all 5 loans. And I'm like, you're an idiot.
Yeah.
He literally got. He's active duty. His dad's an admiral.
So he's fine.
Yeah, he literally got a call on the phone. And they're like, you owe us $750,000 today. Like, we need. So like, we're like rushing trying to find this dude some like commercial loan to wrap one of his properties in because he's about to get nabbed for a $750,000 check.
Too entrepreneurial.
Yeah, too.
Yeah. You see, I mean, we all know the like, active duty real estate investor. It's like, you got a lot of time, man. So this 3 months of PITIA, that's principal, interest, taxes, insurance, and association fees. This one's big. You have to have 3 months of cash reserves for that individual property. So if your HOA is $500, take your PI, your normal payment that you're making every month, add your HOA to it for 3 months. Property valuation appraisal. So VA loans had a terrible stigma about like, oh, you can't have chipping paint, or you need handrails, or like, this is not true. Like, it's really flexible, it's really dynamic, it depends on each property, but like, don't worry about that stuff now. Find a house that you like, we'll figure out how to make it qualify for the VA loan if you want it. Like, if you find out through an inspection that it has, a wall that's been eaten by termites, probably gonna advise you not to buy that house. And these are the termite required states. But so what I'm saying is like, where do I live? I live right here. Technically a termite required state, I didn't have a termite inspection on my house. So there's ways to get around it. Now my house doesn't have any termites, and this is when like, in a very competitive market, you'll see sellers say stuff like, I don't want an inspection, or I want no contingencies offered. There are ways to construct things and ways to get inspections done prior to you making an offer, or even congruent with your like parallel to you making the offer. So like on my house, my second house, I won the offer and I was like in process of signing it, had my home inspection done, found out that like it was all good, new plumbing, all that stuff checked out, submitted final offer. So like I knew I was gonna win the offer, had the inspection done at the same time that like re-verified what I saw in person, and then put the offer in officially, put the earnest money down, closing the house. The rest is good. Everything can be waived other than appraisal. I already talked about that. It's the one thing gotta have. And if it appraises short, so let's say you're buying $1 million house, comes in at $950,000, you just bring $50 grand to the table and closing your house. And again, that can be a loan or any seasoned cash. But that's fine. We see that. And there's other ways to make it work. You can go back to the seller and say, hey, it only appraised at $950. Do you give me a credit for $50,000? Which is good. And sorry, my computer keeps shutting down for some reason. Underwriting. So underwriting is the step when we find a loan product that works for you. An underwriter looks at your specific file and decides how much risk you have. So in there is your DTI, your income, and the biggest one that like is a hard stop is residual income, which means that, so the highest in the country for family of 4 is $1,400. And there's some stuff in there, right? It includes everything. PITIA, debts, childcare, maintenance, which is monthly maintenance and utilities. It's calculated at 14 cents a square foot. So a 1,000 square foot house, you just multiply 14 cents. Income taxes, Social Security, healthcare, like continuing education, everything. Every bill that you have comes in that. And if you don't have whatever amount of money that we calculate for your family size and where you are, the VA will not allow us to get a loan for you, unfortunately. But most of the time, I'd say in our income bracket, class, whatever, we don't really see this an issue. We see it usually on like the enlisted cat side. They're trying to buy a nice house for their family. They maybe don't have on paper as much income as they need, and so they start to touch that residual income phase. It's not really a thing you have to worry about, but just know that like West Coast and Northeast are the most expensive areas. One thing I do like to point out here is that the Southeast somehow includes Delaware. Never knew that was a thing. I'm from New Orleans, and I didn't know that anything about Tennessee counted as the South. DTI calculations, so you'll hear terms like front end, back end, doesn't really matter. Front end is your mortgage, back end is everything included in that. Insurance, loans, student debt, childcare, all that stuff factors in. So front end DTI limit, we usually like to see about 45%. Like anything above 50 is gonna be tough for us to find someone. Back end, we've written loans up to technically 69.9%, and that's like the maximum legal limit federally that we can ever do. And manual underwriting is a savior. This is why we chose to structure as a broker instead of a internal lender or like a lender, is because we get to brief people's files. So let's brief my example, right? So like I had a good credit score, I had no student debt, my wife was active duty, I was gonna make 150,000 base and then another 150 bonus. Can't count the bonus for 2 years. But when I brief someone, I get to say like, yeah, here's this cat. He went to the Naval Academy, then he went to Wharton. He has no debt. He's got an 800 credit score. They have $300,000 in cash reserves. He's gonna make 150 grand a year. He's got $4,000 in disability. His wife makes 125 a year, and on top of that, he makes another 150 in bonus every year. That's like most likely gonna happen. That underwriter's gonna start turning his or her wheels and be like, oh yeah. Like I'll write that loan. Like that makes sense. And that doesn't happen unless you have the ability to do manual underwriting. Student loans, some of us have student loans, and I did. It's not really a big deal. You take your balance, divide by 12, multiply by 5%, take whatever that is, and that's just what it counts per month. Student loans are a thing. You just work through it. It's not that bad. Loans and leases. So if you have a car payment that has only 10 months left on it, you can exclude that unless it's significant, right? So you, on deployment, you bought a Ferrari 456, and your monthly payments, I don't know, $5,000 a month, significant, right? Like I have to count that. Spousal debt, this is big. My wife had student loans. If your spouse has student loans, it goes to the community property law of that state, which again is just something we work through. Childcare could count towards DTI. It always counts towards residual. So it could affect your DTI depending on where we are, but it definitely goes back to that residual amount that I talked about. And this is my absolute favorite one: commuting costs. So what do you think the monthly commute has to be? The amount of miles that you spend in a vehicle for me to have to be like, hey, we need a letter of explanation. What do you think of that?
10,000.
Ooh, that's pretty, a little, 5,400 miles.
Oh,
If you were driving 65,000 miles a year to commute to your job, then and only then do we have to be like, hey, you might want to submit this letter explaining why you're driving from Denver to San Francisco. Other than that,
don't give me a loan, just kill me.
Yeah. Look, I commuted 42 minutes and I wanted to jump in front of that subway. But like this comes in, if you have a hybrid gig and it's here in SF and you want to live in San Diego, that's fine. Like it's a 1 hour flight or like a 4 hour train, or probably 6 hour train, that's fine. Like if you're coming up to the office once, twice a week, like we just write a little letter, or you write a little letter saying like, I plan to be in the office on Fridays. Like it's a $100 Frontier flight. Cool. So this is what a simple DTI calculation looks like that like you can do in Excel. So you just take your base salary, whatever disability you amount have, your debt per month, get your gross, and then this is like a very simple just like payment calculator. So unfortunately, we're definitely gonna be like over here until rates slow down a little bit. But like, here's the beautiful thing about VA loans. Your cost to refi is like nil, because we can do, like right now we have an IRRRL that is lower than current market rates, an interest rate reduction loan. So we could technically find you a loan today, let's say it's at 7.25%, and then 181 days from now, earl you at 6.25%. It's unreal. And your cost of that is like a couple $1,000, and we roll it into the earl. So you're like, really, you're doing it almost for free. So that's when like people, interest rates are big, right? And these payments are big. You know, like if you're making like, when I qualified for my house, and we'll get to what it was, but I was at 55% front end. I was at like 68 back end. I was stroking a $14,500 check a month. It was a big check every month, right? But the thing is like that house is now producing income because the housing market has been, I mean, considering everything, there's still an immense amount of pent up demand and not a lot of supply because people are locked in on those interest rates and they don't really want to sell and all this stuff. And like, I'm just telling you, like, if you find a house that you love, like, again, don't buy a house because you think it's a great investment. Buy a house because you want a house for you or your family, or like you want to be in that area long term. Like, if it is an investment, that's on you. Like you know, people always ask like, how did you know that your house is gonna be a great rental property? Because it's a townhouse, and literally the adjoining townhouse rented for more than my mortgage. So I was like, okay, I feel comfortable like, you know, chewing this bone. So, you know, and we can talk about that. Like, I can help you, but unfortunately, I can't like legally advise you on like a rental property. You know, but like, just do your diligence. Like, you're all really smart men and women. Like, you got this.
Quick question. For disability, you said you increase it by 25%?
Mm-hmm. Okay. Yeah. So yeah, if your disability is 1,000, it becomes 1,250.
Why?
It's because it's untaxed, and it's your income, GTI, and all that stuff is based on gross. It's a pre-tax.
Got it.
And that's again stuff that is relevant to us: BAS, BAH, VA disability. That's really that. None of us are really ever on Social Security, stuff like that. It doesn't really apply to us. Multiple buyer scenarios. So this, I get this stuff a lot. So 2 non-married veterans. I'm probably gonna advise you, like my wife and I are in this boat. If you guys are on the path to get married, I'd probably tell you to get courthouse married, and this makes this a lot more simple. If you're not, that's still cool. The VA will need to underwrite, meaning the VA will need to weigh in on whether or not they approve the loan. It's a really simple process, it's not that bad. Each veteran gets charged 50% of the entitlement, which makes sense, right? You're splitting the loan, and you can't stack entitlements. So like, if one of you had bought a house previously, unfortunately, it's just gonna go off the lower person's entitlement, which is it's not that big of a deal. But like, you can't like stack the two together and buy like, you know, I don't know, the previous example I said you could buy 10 $114,000 houses, you can't buy 20, right? So you can't stack them together. This is one that I see a lot, specifically with MBA and graduate students: a non-married, co-borrower, non-veteran, and then one veteran. So if your girlfriend, boyfriend, whatever is employed, not a veteran, you want to use his or her income, that's fine. We would just basically show that they have interest in the loan, that they're going to be living with you, like all this stuff, that you guys are buying this together, and then your VA entitlement gets charged. They would only, again, it goes back to this 50% entitlement. They'll only guarantee 12.5% instead of 25%, so that non-vet would bring the additional 12.5% in cash. We also see this with adding parents to the loan. If you need, you know, extra income to qualify, we add your parents to it. They have income, buy that house, all good. So there's lots of ways to make it work. It's just like which one's going to work for the scenario you want. Property types. So your first, I would say 80% of the loans, no, probably more than that, 90% of the loans we write are single family homes. Freestanding, single family, only you and your kids, spouse, whatever, inside. The VA's mission is to provide housing for veterans. So it's, you can't buy, if it becomes an income earning property, that's fine. But like, you can't buy a property with the sole intent of making it a rental. unless it's like a multi, you're living in it. So you need to occupy within 60 days, or else the VA starts to get weird. Now, at 60 days, like no one's gonna come knock on your door, right? But if they see it pop on Zillow, and because they do random checks, I can't tell you that they don't, but like they do random checks, and they're like, oh wait a second, this rental that this guy bought in Vail is now, or this house this guy bought in Vail is now an Airbnb rental. Interesting. They'll probably just call and be like, hey, are you using this as your primary residence? This is what I'm talking about, that valid change in circumstance. It needs to be occupied for 1 year. Now, if you hit 1 year and a day and you want to buy another, cool. If you hit 6 months and you lose your job, like me, I didn't lose it, but you decide to quit, that's fine too. Like, the VA is understanding. Like, people make mistakes, like, that's fine. I literally just wrote a letter to the VA and I was like, hey, like, this is a big loan for me. Like, I don't want to keep doing this job. I don't want to not see my family. Like, I want to get out of this house. And they approved it the same day. They're like, you're good. And me and my wife went and bought a much more modest house. And I decided to do something with purpose instead of padding the pockets of billionaires. Remote work just needs an employer statement of in-office versus work from home requirements. So, you know, a lot of us are going to have jobs that have, 25 to 75% remote work. That's totally cool. It just needs to say that in your offer letter, and then that kind of unlocks you to maybe even go further than that max commuting distance I talked about. And then this is a really cool one. The property can have a single accessory commercial dwelling. So that's a new one. So like if you bought a warehouse that has an apartment, right? The apartment owns the warehouse, but then you rent the warehouse for $300 grand a year, all good. Right? That would take a very special case, and I haven't yet seen it, but if there's gonna be someone that's gonna figure it out.
I feel like bars are.
When did that come out?
That's like God, I don't know.
I was trying to do this in Chicago 3 years ago.
Oh yeah, no, this is fresh.
Yeah,
This
okay.
is like, yeah.
That exact
I feel like there's
scenario.
a story.
It's so cool. So we
It's like they wouldn't do it though.
we haven't done one yet, but like in Philly, so someone mentioned a bar. There was a townhouse in Philly that had a restaurant attached to it. The restaurant rented this restaurant space for like 15 grand a month. It would have paid almost the entire mortgage. But like at that time, like this wasn't a thing. So it's like if you find a property, like let's see if it works.
Cool.
And like I haven't tested this yet, but like that's what the law states. Like so, you probably get this out. Multifamily's all day.
On that last one, on the third bullet, the 1 year thing,
Yeah.
do you have to refi out of your, you just keep the same loan you had, and then use the VA loan again?
As long as you're under the county loan limit. That's the only time the county loan limit applies. So if you have a California county limit's like 1.123, I think, or 1.23 something. It's over $1 million, right? So let's just call it $1 million. If you bought a $500,000 house, you've used, so on that you would use 25% of 500, so 125. Trying to do.
Yeah.
This is called 400. You buy a $400,000 house, you use $100,000 in entitlement. The county loan limit's $1 million. This is what I was talking about with yours. So your county loan limit's $1 million. So your county loan limit is eligible for $250,000 of eligibility. You've used 100. You take 250 minus 100, you get 150 remaining. Multiply that 150 times 4. So then you get $600,000 eligibility. You can buy a $600,000 house with nothing down. This is the beautiful thing. Let's say you want to buy a $1.6 million house. All you're going to do is pay 25% down on the remaining balance, that 1 million from 600 to 1.6. So you bring $250,000 to close on a $1.6 million house, still using the VA loan, still keeping your previous property, your previous rental, whatever.
Because you're just paying for what the VA would insure to the lender.
Precisely. Which is incredible, like insane math.
Yeah.
And that's
Interesting.
so like.
So you can bust that limit, you're just paying the down payment of whatever the excess is.
Yeah, exactly. And that's what I'm saying.
I've been
like,
wrong this whole time.
people mess up all the time because you'll hear some lender say like, "Oh, you don't have any entitlement remaining." It's like, well, technically anyone who buys over $144,000 doesn't have any basic entitlement, but like you always have technical entitlement remaining. I mean, technically, you can use a VA loan even if you have like whatever county loan limit and you just put 25%. Now, I guess you could do this if for some reason the market rates in the VA loan were drastically less than standard loans, then you would want to use the VA loan and just put that 25%.
So I guess is that if you're buying properties in the same county, or is that just across, like, if you have multiple counties?
Now, let's take an example. So, let's say you bought in Virginia Beach, and you bought in 2014, and the county limit was $400,000 then. So you bought as much of a house as you could, and again, you had a different lender that didn't know what they were doing, and they told you you could only use the county loan limit. You bought a $400,000 house, used $100,000 eligibility. Fast forward 2024, you want to go to San Francisco, San Francisco, New York, DC, Miami, Alaska. I don't know why Alaska is so expensive, but like these places have really high county loan limits. So let's just say that's 1.25, or let's just say $1 million for easy. So you have $250,000 eligibility. So you've used your 100. So you just subtract your new county loan limit eligibility minus your 100 that you used, and you have 150 times 4, 600. So it's only relevant and it's only based on your single family. I see this a lot where inexperienced lenders will say, or I'll have people that come to me and they're like, oh well, like maybe federal said that I can qualify for more on a multi, because they're using the multifamily account. Like the multifamily county loan limit can be up to like 4 times what a single family is. They're like, well, you're only telling me it's single family. Like, well, the law is single family. Like, I of course would want you to buy the biggest house that you possibly can. But it's only based on multiple purchases. It's only based on single family homes. So that's just something like where knowing the ins and outs of this stuff really matters. So in a multifamily property, you can get up to 4 family. Anything above that is technically commercial property, but let's say you were buying a new build townhouse in Arlington, Virginia. My roommate from Navy did this. He bought a new build. There were 4 adjacent units. If that can be transacted in one sale, good to go. You buy those 4 units. Let's say you personally approved for $1 million. The next 3 you would get to count 75% of the prospective rental income towards your gross payment. So like on a property that let's say was $20,000 gross payment for those 4 properties, if the other 3 rent and like your payment's $4,000 and the others are renting for $5,000, well cool. Each one counts for itself, $4,000 a unit. You don't pay any money. You just got a really sweet spot. I guess it'd be $5,000. Does that make sense? What I'm saying? You get to count 75% of your rent towards your mortgage payment on those other units.
Okay. So that they're guaranteeing a buffer.
It's that's an occupancy standpoint, so they can't assume that you're now 100% occupancy.
That makes sense. Yeah.
If it's a new spot. Let me talk about that a little more because that might have been confusing. So if you're going to buy 4 units, you're going to live in this one, and they're $20,000 a month is your total payment for all of this. So right, so each one presumably is $5,000 a month. If this rents for 5, this rents for 5, and this rents for 5, you get to count 4 of it, and then you're paying this 20. So then we get to subtract 12,000 in your rent, and as long as from a DTI standpoint, you can afford $8,000 a month, and you can qualify for that 4-unit building. Does that make sense?
Yeah.
More now? Cool. And obviously there's a ton of information in this, so don't feel like I'm never gonna talk to you guys again. I'll give you my contact info and like we can work through case by case stuff. Your likelihood of success as a landlord. So that's the only thing that the VA says. What the hell does that mean? Like, I love, my dad was a lawyer for 50 years, and I love this, right? Like, this is the only thing. I'm like, okay, well, just like being a military member that handled like, levels of national security, and then went to, Berkeley and got an MBA, like, is that likely, like, does that count? Okay, cool. you're gonna qualify for likelihood of success as a lender. Cash reserves, you do need 6 months of mortgage payments in cash, and that's in case, this unit fails to produce, you can still pay it off without screwing yourself. So that's the only one. If you're buying some big old mamma jamma, you just better make sure, like if you're buying this, you just need to make sure you have $120,000 in cash. That's a pretty hard and fast rule.
I think my question was, is it 20 times 6 months or 8,000 times 6 months?
No, it's 20 times.
It's the full amount.
Yeah, because if you can't pay for yours,
Yeah.
it's just as bad as the others. If you don't, this is another favorite. If you do not have experience managing a rental, meaning like you haven't been actually managing your apartment rentals for, I think it's technically 2 years, you need to have a property manager in place at closing. At closing. If the next day you fire them, damn, I guess you gotta figure out how to manage it. That's ridiculous. And again, the 75% of rental income is included in your effective income. So that comes into place. Again, if you have a rental already, you get 75% of that rental income. So if you're earning $5,000 a month in rental, we count $4,000 towards your gross. If your mortgage payment is above that, then we just take whatever that is, subtracted minus 4, and that just goes to your DTI.
What was the cash reserves for single family?
No.
None.
Yeah, on the cash reserve side, so when you close, depending on the county and some other things, you do need about 3 months of insurance, taxes built into your escrow. That's really the only time reserves come into effect. And that's just so that you build up this little escrow nugget, and escrow occurs until you reach a certain point in the loan, and then it falls off, and then you just start paying your taxes and insurance out of pocket. But for all new purchases, you're gonna have an escrow account, which is just lumped into your lump payment, principal, insurance, taxes, interest, taxes, and insurance. So this is what I was talking about, that single family versus multifamily. So let's go back to that person who's making he or she's making $180,000 working at Google. They have 50% disability, no debt. So this is what they would be able to purchase on a scale wise for a single family. So somewhere between 1 and 2 million, depending on the rate and the prospective underwriting. This is back end DTI stuff. So, this goes into your personal view, right? I love my house. I feel at home when I walk in. I'm the type of guy, and so is my spouse, that we want to have a really nice place. So we tend to spend more on housing. That doesn't make me right, and someone that spends 20% wrong. I wish I was that guy, honestly, but I'm not. When I walk inside, I want that big mamma jamma, and I want to enjoy that I'm there, and I want a steam shower, and I want that, right? And I feel like we've earned it. So that's my personal view. But if you're I only want a $500,000 house, dude, great, awesome. It just didn't exist for me, so I was like, you know what? I'm gonna buy this $2.75 million house and enjoy it for a little bit. I don't know. I'm gonna start ranting here, but I don't know why you came to an MBA program, but I can tell you I did.
Steam shower.
To go to country clubs and to eventually have a Porsche one day. And then I realized that investment banking you don't get any time to do any of that. And now I, fly around the country and hang out with my friends, so that's pretty good too. On the multifamily side, this is what gets interesting. So that same income level, you're qualifying between 3 and 6.5 million because you're using a multi. And again, this comes in your personal views on what you want out of a house. I have 2 kids. Multi's not really a thing for me. Probably there's any rental property, you're gonna have maintenance, you're gonna have tenants, you're gonna have stuff to deal with. If you want to deal with those things, they're a great way to earn money, a great way to set yourself up for the future. but like even my big family, my big income single family home that I rent, I'm still there a couple hours a week, like changing light bulbs, doing dumb stuff. That's just kind of like what comes with the turf. So for me, like a multi-day workout, but and this is my purchase there. So we were in DC through COVID, and I just like didn't want to do the city life, so we immediately looked at the suburbs. And also, the funny thing, and this kind of like jump-started this whole thing, is that I couldn't qualify for a rental that I wanted in New York. So I have 2 kids, I need a 3-bedroom. There literally is not a 3-bedroom, well, in a place that you actually want to live in New York City for less than $8,000 a month. On paper, I can't qualify at $150,000 base. I couldn't qualify for an $8,000 a month rental. Because you need it's 3 times your income, your rent to your income. So for me, I would need to, for a $8,000 a month place, I'd technically need to make $24,000 a month from a like New York basis. That's ridiculous, right? So I'm like, all right, I guess I'll go buy a $2.75 million house. Fine. So I did that. I purchased in March of 22, closed in June of 22. So this is a beautiful thing. If you start looking now and you find a house that you love, but you don't start your job until June, use that as a negotiating tactic. Because sometimes, like in my case, that will actually benefit you. So I did not have the highest offer, but it turns out the person I bought my house from was a school teacher. Now, like this gets into like another conversation, like school teachers selling a $2.75 million house. But anyway, she's a school teacher, and she needed to be there till June. So for me, even though I was like, I don't know, some amount of money less than the next highest offer, because I was willing to let her sit there for 3 months, it was like, oh yeah, we'll take your offer. Because everyone else wanted immediate occupancy. So this comes into like, the art of the deal. But like, use that to your advantage. Like do some research, find out what their first rule in negotiation, find as much information out about the person you're negotiating against. Like, there's these famous stories, right? Like about like business people spending 90 minutes of a 100-minute meeting, finding out what the other person wants, and then using that to their advantage. So like I waited until, I talked to the builder, I talked to every person I could to find out as much information, found out she was a school teacher, found out when her specific school let out, and was like, perfect. I start on June 21st, she gets out of school end of May, June 3rd closing date. It was perfect for her, so it worked. My estimate as of January 22 is 3.2 million, so I've already had a 10.6% annualized return. My payment, including my association fee, which includes all maintenance, is just under 15,000. As a rental property, I'm on a 3-year lease at 17 grand a month, so I have a 6.38% cap rate, and that's at present market value. To put that in perspective, a normal income earning rental property, single family, is like 5.5%, so I'm doing pretty good there. And this is where it gets really exciting. My 4-year ROI for rental is at 50% over sunk cost. So closing costs, PTI, while living there, everything. I'm making 50% return on investment. And if and when I sell it after a 4-year hold, and when my wife graduates from Columbia, I will walk away with $450,000 in cash in my pocket for putting $51,000 down to buy a house. Like, I don't know about you, but that was a whole hell of a lot easier, and that's a whole lot more money than I ever made as an investment maker. So that's, but this is a special case, right? Like, you gotta find, if you want to do this, you have to find a case that makes sense. And I don't know what that is, but like, you are all very smart. You can probably find something if that's what you want to do. But even if I lived in this house, like I was still living in it, that's great. Like I'm good. Like I've lived there for free. So if you haven't had a chance yet, please fill out this survey. And I'll go through and I'll show you kind of like how you calculate DTI, how you find your taxes, stuff like that. And also you can put in some questions in there. And I think live, we should just ask, if you have questions, let's just handle those now. is it still worth it to use the VA home loan a second and third time? Hell yeah. Yeah, even if you've used all of it, you put 25% down, you get a below market rate, it makes sense. If you haven't used all of it, you're still getting a bump from the VA guarantee on the backside, that's great. Ease of refinancing from a VA loan to conventional. So what I'm assuming you mean there is like a cashback refi. It's pretty straightforward. Refis in general are easy. You would just need an appraisal and an income verification. It's not as intense as a regular underwriting process. And depending on the rate at which you currently own, how much equity you have in the house, like all that starts to play into the case. And it's very case by case dependent. It's kind of just like some simple math to figure out if it makes sense. I mean, sometimes it doesn't make sense to refi and makes more sense to get a HELOC. So I'll give you an example. I have a classmate of mine from Yale County. He bought, I think, like a $450,000 house in Virginia Beach. That house is now worth $750,000, so he's got about $300,000 in equity. On a HELOC, he can do 90% of loan to value, so we get to take 90% combined loan to value of that $750,000 asset. But his $450,000 house is like 1.9%. Leave that. Like keep that. Take your HELOC to get your cash, and then use that as your down payment. And like that's a pretty. I'll step through that. That's actually like a pretty cool thing. Is let's say, so his specific example. So let's say like he's taking out $300,000 of a HELOC, and that's at 7.5%. And then, so he bought a house at $450,000. So his VA county loan limit is like $650,000. So let's just say he's got $150,000 of VA eligibility remaining. So again, you take that times 4.
What's the 4?
The eligibility is 25% of the. Who asked the question?
No.
The eligibility is 25% of the loan. So on $1 million house, your VA eligibility would be $250,000. So if you have $150,000 of eligibility remaining,
Tells you the total quantity.
the total quantity for no down payment. So what's cool is so you have 600,000, and then you add your 300 to it, so you get 900,000 no down payment, right? Your HELOC's at 7.5%. Let's say that this loan is at 7.5 again. So you get a $900,000 house at 7.5% that you before that would have not been able to afford. He's bringing no money to the table, none. If he has cash, again, he's adding more to it. That's a pretty, this is a real example. They're buying a house in Jacksonville, $900,000 house in Jacksonville, pretty sweet. Jacksonville, Florida, not Jacksonville, North Carolina. $900,000 house in Jacksonville, North Carolina. I don't know if that exists.
You just bought the city.
Yeah, you bought the entire city. How do you get started? That's a great one. You send me a text or email, you pull your certificate of eligibility, you do a soft credit pull, you start seeing what rates look like in the market. Like, quite honestly, they've just been dog shit this past week. But the week before, like, rates are a wild thing, and it's crazy to see. I mean, they can fluctuate 1%, like 100 basis points in a day. So that's like, we'll get into a discussion later in the loan process of what's called a float or a lock. I wouldn't necessarily be obsessed with it. Like some people are like, oh, what that means is if you float, you're continuing to leave your loan open until the date of close or a date that you choose along the closing path, usually about 30 to 90 days before closing. 0 to 90 days before closing. I would say that when you and I see rates that you like, right? So let's just say it's 7.5 today, and then next week they're at 7, and you would feel fine. You wouldn't like kick yourself in the ass for doing a 7% loan if it fell to 6.85. let's just lock. Like, you're talking like $200 a month. Just do it, don't worry. Because what could happen, and we hate to see this, because like, I'm gonna give you advice on like when we have some really awesome analysts that look at, you know, treasury yields and all this stuff and kind of give us like their guess, but they're right 51% of the time, which makes them by far and away like great, but it's sometimes they're wrong. So we left some loans unlocked because the buyers wanted to. We were in an interest rate falling environment, or falling interest rate environment, and this week's not been good. I mean, we're at like 7.25, where last week we're at like 6.25. That sucks. I hate that. Because I can't do anything. Like, I mean, you can like buy points and stuff, but like sometimes that doesn't make sense. So that's a conversation that we had. This is why like starting to get your file in, starting to watch the market, like having someone watch the market for you, and start to say like, hey, like maybe now's a good time. That's the thing. So how do you get started? You send me a text or an email or phone call or a pigeon message or anything. I love this question. How creative can you get in terms of property type? Real fucking creative.
That was me.
Yeah. Here's an awesome example. So you cannot buy land with a VA loan. That's like the overarching thing. But you personally can buy land, refi, and then you want to build a new construction on that land. You would technically refi your land construction, or rather your land purchase, into the VA loan and classify that whole thing as a construction loan. So if you bought a $500,000, I'll give you a good example. So I wanted to buy a 65-acre island in the Chesapeake Bay. It was $350,000. I was gonna subdivide it and put, eventually I wanted to put like 30 tiny homes on it. But like one tiny home on that piece of property makes that a single family residence. So let's say I purchased it for $350,000. The cost to build a tiny home, let's say it's $150,000, so $500,000 all in. I find someone to build that for $500,000, or sorry, for $100,000, and I finance the entire thing to the VA loan for $500,000. So that's real creative. We can't do like, unfortunately, like boats or RVs. I mean, I can like refer you to lenders who do that, but like that's pretty creative.
2 quick follow-ups. If you have land that's in a family trust, can you still execute that strategy by refinancing that land that someone in like, or it's like a family holding company?
Yeah.
But ultimately the land has to be transferred to you.
You would have to be primary on the title, which
So it can do.
like yeah.
Okay, and then the other thing is, we talked about partnerships, but can Michael and I go and buy
Together.
a fourplex together?
Yes.
Can we
100%.
go beyond a fourplex
No.
if we're going together?
No.
Okay, so we're still limited
Because
by the
it's-
property type cap
Yeah, and that's not a VA stipulation, that's a national lending thing.
because it's commercial.
Because it's commercial.
Okay.
But if you had a 4-unit that had a commercial property attached to it, that may work. As long as, I don't know, I've never seen it, but like.
And
that'd be
then,
something.
and then what would be our limit? 2 independent veterans that are not joined by any marriage or anything, do we get to double our eligibility? Or how does the eligibility work?
Do you previously own a property or not?
Not with the VA, but yeah.
But you have no.
I've never used
your
the VA.
certificate of eligibility says nothing.
Yeah, yeah.
You can
We're
buy,
both-
technically you could, if you could find a wholesaler or a lender to do it, and you guys qualify for a $10 million place, you can buy a $10 million place. Yeah, it's just finding like.
Cool.
He's like, got it.
Oh, yeah.
This was not allowed like 3 years ago.
That's how my mind works. I'm
Yeah.
like, I go to the polls and everything. I'm like, oh, you approved me for
Yeah.
2.85?
What about-
I'm buying 2.85. Yeah. Oh, you approved me for a $2 million single? I'm buying an $8 million multi. That's exactly how my mind works. So it's good to see that like West Point trained you well.
I spent like 6 hours on the phone with like people in the VA and just like going through exactly what you said about like nobody actually knows. Like nobody
that's-
fucking knows. And they're just like,
that's-
why don't you just go normal loan so my life can be easier? And then eventually I got to the bottom where you can't buy the commercial with the resident space, but
Yeah,
now
well,
it's
you
approved.
gotta find, so like, I don't want to digress. But like, my nickname in the Marine Corps is Master Manipulator. It's like, there are regulations, right? You read a regulation, it says that you can use a drone for, or one of the official things, combat camera may use personal equipment in support of Marine Corps objectives. I was like, all right, here's a drone. I'm going to use that in support of Marine Corps objectives. And then I got in trouble for that, but all right. But it's the good thing is it's regulation, right? So like, if you read a reg and it makes sense for your certain scenario and you can defend it, that's why we've been able to get condos approved and all that stuff. We can't get a co-op approved because co-op has basically like primary right to the property, but like, why can't a condo be approved? Like it should, and that's why I've been able to. So we actually approved like the 3rd condo in New York City. I was the first condo in Connecticut. My townhouse is technically a condo. I mean, it's all just regulations. So like having someone that's read, I mean, there's a VI underwriter's handbook, and like it's not an enjoyable read. But like, if you understand what's in there, you can do incredible things for your buyers. Yeah, let's see what. Okay, I think that was all the questions. Okay, someone wants to put in an offer in the next couple days and would like to understand how they should go. Call me. We'll get you approved. We would get you pre-qual. Oh yeah, so we would get you. I get you your pre-qual is pretty easy. It can literally happen in like a couple hours. Okay. It's like I'm traveling today, but like tomorrow when I'm home, if you give me, I'll send you the link. Where are you buying?
Berkeley. So this area.
Oh, sweet.
Yeah.
Yeah, so I would put you under a brokerage license. So I'm not personally licensed in California. So when I send you my loan link, it'll say like, Will isn't approved in California. I am. We'll broker your loan underneath the brokerage license, which we're approved everywhere other than right now we're waiting on New York and Massachusetts. They should be ready in like the next 30 to 60 days. We're a startup, so just work with us here. But anyway, I'll send you a link, you apply, I do a soft credit pull, income verification for your wife, VA disability verification for you, check out your debts that are official to your credit report, send you a pre-qual letter, and you submit your offer.
So it's that easy.
Yeah, you close. We can close as fast as federally allowed, which is about a week. Okay. But unless you needed a house in a week, no. Just give yourself just give yourself 30 days. Like 30 to 45 is where it gets normal. More than that, the seller starts to ask for like earnest money because you're locking up their asset. So, but like even that, like you put down $100 grand. Now, like you gotta be ready if it falls through, like you lose that money. Like I'm not gonna let that happen. But people have. My business partner lost 30 grand because Navy Federal never showed up with the cash, which sucks. But we don't let that happen. But like there's ways to make it work. So yeah, just
Yeah.
So let's do a little. If you guys have time, if you have to go ahead. I'll send you all this stuff after, and you can run through the Excel sheet yourself. But let's just quickly do one here. Normally, so let's use you as an example. So it looks like most people are gonna make about $175,000. So let's say, yeah. Do you have any questions on that?
Yeah, we'll do that.
How? Where do you?
So now you're dedicated.
All right. So it looks like you got $1 million house.
That's kind of a long story.
Someone's making about $200,000 with their spouse. Single family home in San Diego is the winner. My type of man or woman.
Dude, I want to go to San Diego.
I was stationed in San Diego for 4 years. It has ruined me. All right, so let's go.
Here's the hard part.
Oh, come on.
I'm getting EDU room to work.
Do I not?
You can just do Berkeley Visitor. Berkeley Visitor.
I was logged in on the visitor.
What's the typical time that people start their application before, not this guy who's like, I'm ready to buy right now, but like.
Because I don't do a hard pull, as far out as you want. I can't close you unless you're 60 days out from the offer letter. But like I'm working with the first year MBA at Wharton, so they're what, a year and a half from. Well, it's like it's just good because like we start to see because like we see because like I'm shopping your file, right? So like this first year MBA, she has an offer letter from Goldman to work in wealth management in Seattle. She's gonna make 185 base. Like her husband is an active duty Army officer, so it's like her file is real, and I can start shopping that to lenders and saying like, hey, like this person might be a year and a half out, but like what's it look like rate environment wise? So like it's pretty good for her and me to start getting a perspective of like what it looks like for her specific file and her credit and what kind of house she's buying and all this stuff. Is to give you another example, we had enlisted cat, didn't have the best credit score, you know, needed some coaching to like get this up, like had a predatory loan when he was a younger guy, we had to get that expunged. So it's like, it's just good to start working through that stuff. You're not gonna be in that boat most likely just because you're here, but it is good to like see what's out there, you know, make sure your certificate of eligibility is good and real, there's no mistakes on it. It's not detrimental to you in any manner to have a soft credit pull. You know, realistically, like, are you second year?
For sure.
Your first year? Do you know where you want to go?
No. So like once we decide to move somewhere, we want to buy a house. So it's like once like we identify, hey, we're going to San Diego, or first thing here in the Bay, like we know the target area and we're going to start like broadly looking. Is that a good time to then just reach out and be like, okay, like?
Yeah, I mean, one doesn't have to supersede the other. Like you can start looking without me, or you can talk to me without looking. Like the only time that you're going to need a prequal is when you start looking at houses.
Yeah.
You know, we do see that most, especially now with some like national things that have happened with realtors. I don't know if you've heard about like this class action lawsuit and all stuff, but most states are requiring that now buyer's agents who are officially tied compensation wise to the buyer and not necessarily the seller have to have an agreement with the buyer before they can ever show the house. So that's when you're going to need a pre-qual, because like
To even start looking
to
with the
even
real-
have an
Yeah.
agent be willing to put their license on the line. Because if you walk, again, you're not this guy. You walk into a house, you have slip and fall, and they fall down the stairs of a $5 million house, which this happens. Like they fall down the stairs of a $5 million house, sue the owner for 200 grand. The agent's gonna be on the hook. Their insurance policy is gonna be on the hook if they didn't do the due diligence of like making sure that guy or gal was like actually real.
Yeah.
But again, that's not you, but unfortunately you get lumped into this. So I would say for you, do you know where, like, are you looking at industries and stuff like that?
Tech, probably.
So like what you could do is you could reach out and say like, hey, I think I'm gonna make $135,000 a year. What does it look like for me? And like, I hope that interest rates continue to fall. Like, and that's something that like, I'll just start tracking for you over the next year and a half as you get closer and closer. And like, if they don't, I'll advise you otherwise. I say like, hey, like maybe go rent for a year. Because again, like, it doesn't benefit me to do something for you that doesn't make sense long term. Because you're never going to tell someone to come use Veterans Alliance, and again, like I don't make any money off your rates, so it doesn't matter. You know, like I'm compensating on like a gross aggregate level, like with those wholesalers. So like, and that's the way we want it. I'm not a fiduciary, but like I am in the sense that like I want you guys to do well, and like I want this stuff to work.
Thank you, appreciate it.
Yeah.
Yeah, looking forward to it, I think, thanks.
Okay. Okay, so that was San Diego. Someone's making.
I think I lowballed it. What'd I put? 125 or something? 140?
So it looks like basically the majority are single buyer, single family, 150 wants to buy a 1.25 house. Sweet, let's see what we can get. In my favorite city in the entire world. So let's go for sale. Let's go up to 1.25. And we'll start at $1 million. And we want, let's say we want a 3-bedroom, 1.5 bath, single family, and we want to be west of the 5. If you're not living west of the 5, whew, San Diego's gotten expensive. Whew. All right, let's say Claremont's a pretty sweet area. It's a really sweet area. That's a pretty house. Which one?
That one.
This one. All right. So 1.225. San Diego's a pretty competitive market. Probably not going to get it much under ask. Again, that's where having like a really good real estate agent. And again, if you need people, if you need me to recommend, we have built like an ecosystem. All of our agents that we recommend are either veterans themselves, spouses, family members. Like they are tied by blood or like marriage to a vet. They actually give a shit. And so that's like a big thing, is like they actually care. Because unfortunately, you'll run into real estate agents that haven't had the time or the education required to really like sell your loan or sell your offer to a seller. And that's where like I would step in, call the seller and be like, seller's agent rather, be like, hey, like this is as green of a loan as you can get, like you're good. Because at the end of the day, like VA doesn't want vets to lose out on homes, so you're gonna be fine.
We can use our own realtors.
Yeah.
Stuff like
Yeah. No, it doesn't matter to me. Yeah, if this is so I have a broker's license in New York and Connecticut because I wanted to buy my house. So like by me getting my real estate license, I save 2.5% on my transaction.
Yeah.
So it's like if you've got time, and the other thing is like for me to get a real estate license cost like $3,000 and saved me $36,000 on my transaction. Like it's a no-brainer. Now certain states have certain requirements. It just depends.
Yeah.
But you can even like, yeah, you could find. I would say like some really great brokers. So I hang my license with Compass. I found that most Compass agents are worth their salt. Sotheby's is another really good one. Redfin has great tech. Compass has great tech. But just find someone that you like and like you want to work with, and let them handle your job. So California is interesting in that property taxes are tied to the sale of the home. So actually on this, property taxes are going to be about double because they have a tag tied at 526. So let's assume property taxes are going to be 14,000. So 1,225, 14,000. So
Can you include the taxes in the overall loan?
that's including your back end DTI. Yeah. So you'll see. So we're going to buy.
Thank you.
Yeah, anytime. So this netted, our survey netted out 150,000 base. Let's call spouse base at 100. I didn't ask about VA disability. I'm sure. Let's just say that they're at 80%. Let's just say you actually have no VA disability. So your gross income is 250,000. You have 100,000 in 75,000 in student debt. You have a car payment that's totally normal. A Peloton because you're a millennial. Your net income is 19,000 a month. Your tax estimate. So on this, let's see. So on a 526 purchase, 7697 divided by 526, we get about 1.5% taxes. So again, in California, it's tied to the purchase price of the home. So 1,225. It's going to be $18,000 a year in taxes. What did I say? It was 1.15. Insurance. This comes in very specific on the house for like just like bulk rate. Assume like 0.5% to 0.75. Monthly HOA. Let's see if this one has a monthly HOA. It does. It does not. So that's great. Make that 0. So on your front end DTI wise, these are what you're going to be like we're probably in this range right now. So we can go front end up to 55%, so you're like totally good. This 1225 house, on this person's earning basis, you're good, you're gonna sit right around 40. Like,
And that's 40% of your income.
yeah,
It's
that's your
going to more.
front end, just towards your mortgage, that's fine. Back end is when it starts to become specific to the purchase price, so 1225. Let's say we got a 7% rate, yearly taxes was 18,000. Yearly insurance is gonna be your purchase price times that, so about 8,000. That's probably a little high, honestly, from what I see, probably more like, no, let's just think. No monthly HOA, so your monthly PITIA is 10,000, back end DTS 52, you're gonna approve 8 days a week, no worries. This is where it's good to start, and I'll send this Excel doc out, this is where it's good to start playing with and seeing like, well, what happens if we go back to terrible rates? Am I still gonna qualify? Okay, yeah, I'm still gonna qualify. What happens if it's like 1980? Whew, alright, I'm not gonna qualify, that's not good. I don't think we're going back to 14% interest rates, but like even in this, like you can start to play around with it and see like,
Where's my threshold?
you'd have to go 11% interest, we're not going back to 11% interest rate. So if you know like, you fall in love with this house, you know that you're gonna be set, right? And this comes back to like I mean, this person, right? I'm sure when they bought this house, and when did they buy it? In 2012, they were like, "Oh my God, I'm spending $500,000 on this house." The previous person spent $250, and now they're selling it for $750,000 more. It's like, well, that's a pretty good investment for you. So it's like, again, if you believe in the market, like markets that I personally have experience in, like I bought a house in San Diego, we bought it for, what did we pay, $570, we sold it for a year later for $630, which like, we painted the interior. You know, I bought that house in Greenwich, now a year and a half later, I'm up $300,000, it's like, that's pretty cool. But it's like, these are very like market specifics. Unfortunately, I've seen some markets that have performed the opposite, but these are usually in what I would call like a second tier city. You know, like a place that maybe boomed in COVID with remote work, and then now that people are getting pulled back to the city centers, aren't doing so well. And even there, there's usually great opportunities. So it just depends.
On the bottom right there. Sweet.
But again, if you guys have any questions, let me know.
Recent decision to buy
It's
it.
great to meet you guys.
Yeah,
Thank
that's
you.
super awesome.
And,
Thank you so much.
And tell any other first years that they don't have to go bang their heads against apartments.